Welcome to the Clark Street Capital Coleman Report webinar on workout war stories. John Winnick, we've done this for a while. These are great case studies that you can learn from. All-star panel, William Kruger, Senior Vice President, Asset Resolution Group, Truist Bank, Justin Barr, Senior Vice President, Special Assets Director, Carter Bank and Trust, Jason Alpert, Managing Partner, Castlebar Holdings, and John Winnick, Clark Street Capital. Gentlemen, welcome all.
Thank you.
Thank you, Bob.
No, let me do my moderator thing here, John. Then I'll turn it over to you. Just please, we want your questions put into the chat, and we'll weave those in. And now, John, you can take over. Now I will turn it over to you.
Thank you, Bob. Once again, I think this is our 12th or 13th of these webinars we're doing every 4 to 8 weeks or so, and they've all gone great. Today, we have an outstanding panel. It's difficult to find bank workout people, particularly professionals like this, to be candid. And you will find this group to not only be candid, but highly, highly informative. We're going to take a case study approach today where each panelist is going to give us a good workout war story and a bad workout war story. Without further ado, let's start with Justin Barr of Carter Bank and Trust. Justin, take us away.
John, nice to see you. Nice to see you, gentlemen. Well, I'm going to start by saying that I'm not going to share the colorful story of the business owner back in my native Chicago that threatened my life and had me followed. I'm going to leave the more colorful of our stories to Bill and Jason. They've got some good ones. Instead, in fact, John, I'm going to depart a little bit here. Instead, I'm going to share two very different and contrasting mid to large corporate workout success stories, each with a different lesson. The first is a lesson on the benefits of sometimes taking a quick loss, and the second, a lesson on the wisdom of slogging through a multi-year workout under different circumstances. We're all, of course, familiar with the old adage, your first loss is your best loss, and that is certainly the case sometimes, as it was back in late 2001, when I took over management of a $100 million participation in a total $2 billion unsecured term credit facility to borrower WorldCom while working for Credit Agricole in Chicago, then one of the world's largest banks. Now, WorldCom, as many of you know, was a once high-flying telecommunications industry acquisition machine and Wall Street darling. And in late 2001 was certainly off of its peak stock price. But what struck me is what seemed to be its intentionally obfuscated financial reporting. And I'll tell you, I'm definitely with Warren Buffett when it comes to the importance of transparent accounting practices and understandable managerial explanations, neither of which I felt I had with WorldCom. I was also jaded at the time by virtue of what had just happened with Enron, to which the bank had large exposures. Anyway, I argued and won approval to sell the entirety of our exposure, which I executed through Deutsche Bank's desk in the then nascent credit default swap market, achieving a price of 92 cents on the dollar. 6 months later, massive fraud was uncovered at WorldCom, and it cratered spectacularly with the term loan that I was in trading to zero. I share this story while bearing in mind that commercial workout is definitely backgammon and not chess, and that there are significant elements of both skill and chance. Things definitely broke my way in that workout, but the lesson is nonetheless to trust your instincts. And if you're not getting satisfactory answers to important questions, don't be afraid to take that first loss. In contrast is a workout that began in the mid-2010s and dragged on for 4 long years. I was working at the time for a $150 billion asset bank that was dominant in the food and ag industry. It came to manage a $200 million syndicated credit facility to a West Coast frozen fruit and vegetable processor and marketer. The business suffered from a decades-long lack of reinvestment, and as a result had seriously antiquated systems from operations to accounting. At the same time, it had a dedicated sources of supply from some of the best cropland in the country. My assessment was that there was real value to the core business that could be uncovered with the right turnaround strategy. I managed to convince a fractured bank group to hang in there through any number of restructurings, management changes, and financial advisors with some success. As the workout went on, two highly credible companies started to increasingly express interest in acquiring our borrower. They were initially looking for a deal, though, and the offers equated to around 80 cents on the debt dollar. We ultimately installed a chief restructuring officer and decided that a prepackaged bankruptcy was the best way to unlock full value. And sure enough, our two prospective buyers ended up in a 363 sale bidding war that not only got us out whole, but left over 20 million for the unsecureds. The lesson there, don't be afraid to be patient if you see greater value in the longer view. And I'll say, in my experience, lenders most often err on the side of impatience. And with that, I'd be happy to take any questions.
Justin, these were participations, both examples. Could you give me some color on how to manage these complex participations? Very often, particularly if they're not SNCs, you could have banks with different opinions on the credit, different marks, different risk ratings. Could you share with me some best practices from working on complicated participations like this?
Yeah, so, the first example, I was a participant. In the second example, I was managing the workout as agent. So, as it relates to, working out a syndicated credit facility as agent, just as with restructuring and workout in general, it's more psychology than anything. And, John, my experience is that, bank groups, are always somewhat fractured. When things take an unexpected negative turn, people, institutions, I should say, well, and the individuals managing these credits almost never have exactly the same take on what should be done. So, a lot of psychology. As I mentioned to this group in a previous conversation, I was a business major and a psychology minor in college in workout restructuring. I think I used the skills I learned in my minor as much or more than my business skills.
Yeah, what I would add to that is that you can always find out he who yells first and yells loudest is the person you can ignore, because that's a person who's angry who doesn't have a solution. At the end of the day, in a workout, nobody wants to be there. Not the client, not us, not the equity in the deal. But that's the most challenging part is the negotiation. It's not the numbers.
And then that personality really gets front and center the smaller size of a deal you go and the smaller the company. Larger deals, there's at least a little bit levels of sophistication with management and outside vendors, like their accounting partners, their attorneys. But as you get to a smaller and smaller company and a smaller loan, you're dealing more with the individual. You're lucky if they have a bookkeeper. You're lucky if they just didn't try and get a personal injury attorney to be their outside counsel that you're kind of interacting with. So then it really does become a kind of a one-on-one, what's their personality, what's their temperament, and trying to goose that out without, triggering them to cross some kind of a bridge.
Yeah, both good points. Jason, you're right. When you get down to, the level of, individually owned companies, there's certainly, there's certainly more, I think, passion there. If you're a corporate manager, you can be a little bit more dispassionate than if the, family business is going down on your watch.
Maybe not. No, I don't want to jump on my my war story, because sometimes people know where the writing is on the wall and they want just to be out. So I'll save that for when it's my turn.
I mean, Justin, you bring up a bankruptcy example. I hear lenders with different views on bankruptcy. Some like the fact that there's a bankruptcy process. You get some independence, you get a trustee, you get some more transparency. I mean, it sounds like in the second example, the bankruptcy was a plus. What's been your experience in when a borrower files bankruptcy?
But overall, it's been negative, John. More often than not, it's a professional feeding frenzy. Is what I've experienced. Bankruptcy attorneys and financial advisors just piling on, with the most egregious abuses, in my experience, being relative to the fees associated with the unsecured creditors committees.
I would agree with Justin that the fees are despicable, but the thing you got to remember about bankruptcy, and I would tell everyone, is that when you're in state or federal court, it's litigation and you're trying to enforce a contract. And when you're in bankruptcy, it's a process. And there's an end to the process in bankruptcy, not necessarily an end to the process in state or federal court litigation. So from that standpoint, the only good thing about bankruptcy is that it comes to an end. That's
I agree.
where I view it as a positive. I agree with you. The fees, I mean, I think the last deal I did was $60 million in professional fees between both sides. It was patently absurd what they were charging, but it got us to an end that could move the path forward, which you're not going to get in litigation. I think the biggest mistake most folks make is that they don't understand the difference between bankruptcy and litigation. Litigation is us as lenders trying to enforce a contract. Bankruptcy is a process where the debtor is seeking relief and has to follow the rules. That, for me, is a benefit for us beyond the professional fees. But either way, bankruptcy gets you to a result, and which, at the end of the day, as somebody in the workout world, that's what our goal is.
A resolution is always better than just an open-ended, non-resolved problem. I mean, that's ultimately what we're trying to do, is get to a resolution, and good, bad, or indifferent, it is what it is. The one thing about, bankruptcy is the subchapter 5 process has dealt with trying to eliminate those fees with the speed and the process through the subchapter 5 under an 11. It'll be interesting because I haven't seen anything if they've extended the 7.5 or so million debt limit on max amount of debt that can be filed. But I would imagine that Congress will extend that, especially if we're going into a recession. But it's important that banks and lenders understand that process, and they have an attorney, outside counsel, that knows, how quickly things move and can help them through it. In any bankruptcy, have a specific bankruptcy certified attorney.
I mean, Bill, would you say that bankruptcy is more of a benefit for larger loans where the fees as a percentage of the estate are probably smaller than they are in a $10 million bankruptcy? I mean, could that be why, Justin might have a different opinion than you?
Yeah, no, I think it's sometimes comparing apples to oranges. A small bankruptcy most of the time doesn't need to be filed, other than the debtor doesn't want to deal with reality. In a large case, it's a business process.
Right.
It's, you've got to deal with the debt. You've got to resize the debt. Either you're going to sell the company or the lenders are going to own it, but it's a process that's organized, as opposed to litigation where we're seeking to enforce a contract, which is not. Whether you're in state or federal court, if you're in state court, it's a nightmare. The proverbial home cooking comes into play. In federal court, even though that's not there, it's still a process, and it's us as lenders trying to enforce a contract. Where in bankruptcy, it's you've got a fair arbitrator in front of you, while the judge will always want to try to keep the company going and preserve jobs. he's also realistic to the obligations of the company as opposed to a state court where it's just, the bank seeking to foreclose on its assets, whatever they are. So from my perspective, once you get north of 10 million bucks, I'd always rather be in bankruptcy court. South of 10 million bucks, it's a crapshoot. And that's really because the company can't afford to pay the fees from the lawyers and the professionals in order to get out of bankruptcy. And that's the biggest problem, is that people take on bankruptcies where there's no exit strategy.
Yeah, all good points, Bill. And, I will say that, that when bankruptcies worked well, for me, it's worked very well.
Yeah. Let's move on to Bill. Bill, you've got a couple of war stories. Let's get after it.
Yeah, the first thing I would say is 95% of what we do, and I'm sure I can speak for Justin and Jason, is that it doesn't fall into this category. It is pretty straightforward. You get on the other side of the table and work out with people, sit down and try to come to a solution. Kind of the worst situation I had was a owner of a food manufacturer who decided to vertically integrate. This was $7 million in debt to the bank, and it was an SBA loan. And unfortunately, this person did not accept the fact that it wasn't a good manufacturer, and the company became insolvent. We spent probably 2 years trying to work with this individual to get to some kind of plan that worked. And at the end of the day, I wound up on Bloomberg. People calling me, we were destroying a company, we were taking away from an individual, when the reality was the company was insolvent. At the end of the day, instead of walking away from the company and allowing us to sell it for about $5 million and reduce the bank's losses, it was a 2-year fight to the bitter end, and individual wound up in bankruptcy. We wound up losing $4 million instead of $2 million, and it was just very, very, very unfortunate. And it goes back to what Jason and Justin were saying, where you have an individual versus a corporate entity, whether it's a corporation or whether it's an equity sponsor, who knows they have to go back to the capital markets and act rationally. And when someone doesn't act rationally, it just increases your losses, and there's absolutely nothing you can do about it. I would defer to Jason or Justin if they had a situation, but most of them in mine where these people just don't have access to capital to fix the problem. And when that comes about, it's like we are where we are, and it is what it is. And unfortunately, these individuals will not accept reality, and it's just becomes a fight to the bitter end, no matter how cordial you try to be or no matter how helpful you try to be to them. And you can offer them everything in the world, but unless you basically say, we're going to give you your company, it winds up in a very difficult situation. And that's probably, we lost $2 million out of thin air for absolutely no reason. And on the good side, when you get in the corporate world, on a large syndicated transaction, there's always buyers for your debt. And like Justin, I was in a difficult transaction that had 27 banks, 9 credit facilities, and $1.2 billion in debt. And I was able to organize a debt sale where I sold out before the hedge funds came in, and organized a sale that wound up getting us $14 million we didn't deserve. But yeah, you laugh, Jason. It was very lucky timing.
Yeah.
It was I disappeared on a Friday and showed up on a Tuesday, and nobody wanted to talk to me after Tuesday when I sold my debt. But those are the kind of things where if there's an organized market, there's the ability for everybody to make it.
So you mentioned the SBA. We do have some people here that are in the SBA lending industry. In the first example, how did the SBA involved in the loan make a difference? Was it better, worse? Obviously, got an SBA guarantee, so that helps. But just curious.
We had an SBA guarantee, but we didn't follow the SBA guidelines for real estate. We followed our own. So we wound up not getting the guarantee on the real estate, which cost us a couple million. And when you're doing SBA loans, you've got to have SBA specialists. So instead of the regular loan officers. In this case, the gentleman who did it is a great friend of mine and been one for 20 years, but just did a straightforward loan. And we didn't follow the SBA guidelines, so we lost the SBA guarantee.
And if you don't follow those SOP, like the standard operating procedures, which change pretty regularly, the government, as usual, will try and find any which way they can to impair the guarantee. So it's critically important you follow it, you do your inspections on time, you grade it appropriately. So if and when you do go through the liquidation process, which, to get to your guarantee, you have to get to that point. You say, here's my loss, and then they'll say, here's your 75%,
Yeah, in this case, it was a residual issue with because of a prior manufacturing company there. And while the Florida Department of Environmental Regulation was never going to take any action, they weren't going to give you a release letter. And that's what the SBA demanded. And from our standpoint, it was a non-issue. It was monitored. It was taken care of from a bank policy issue. And that's what we did. And, wound up costing us $2 million for absolutely no reason other than we didn't have somebody who understood the SBA regulations when we booked a loan. And all these things come down to one thing, which is everybody's got to come into the room and just take a rational approach to these things. Look, at the end of the day, nobody wants to be in this deal. The banks don't, the clients don't. And if you come in there thinking, other than, in the case of large corporate fraud like WorldCom or Enron or some of those, if you come into the room with anything other than that, you've started off behind the 8 ball. I mean, that's just my experience having done this for 20 plus years.
So it was a $2 million loss in which you would have had a 75% SBA guarantee. Then it became a $4 million loss with no guarantee.
Correct. For absolutely no reason other than we followed our own bank procedures as opposed to the SBA's. And again, we just didn't have the personnel in place to follow the SBA procedures, which would have required.
So basically, it went from a $500,000 loss to a $4 million loss because of the mismanagement of the guarantee.
Yep. And people were like, "How did this happen?" And you got to do the spilt milk stories, and it wasn't anything that the lender did wrong. It was just not understanding the guarantee that was in place.
Yeah.
And sometimes we can be our own worst enemy. So
we are always our own worst enemy. As you know, Jason, I said, when bankers decide to become lawyers and lawyers decide to become bankers, the only thing that's guaranteed is the bank loses money.
Yeah. Evan asked a question. Bill, Evan asked a question. Bill, I was hoping you could flip the script and address how you could have achieved your goals and not call the personal guarantee. Are there ways for a borrower to work with the lender and make it out alive?
Yes. Look, we are where we are, and it is what it is. But if a borrower is going to be cooperative, the bank's going to reward him for that. Mm-hmm. If we get a better result because the person's willing to do X, Y, and Z and not force the confrontation, we're more than happy to provide them, whether it's a lifeline to not personal bankruptcy. But most of the time, as Justin and Jason have said, it's individual businesses who are so emotionally attached, they can't walk away from it. And they're determined to go down with the ship.
And John, here's an example. Almost every time, a business owner, a CEO is going to be, more effective at collecting a receivables portfolio in a liquidation scenario than the lender. And you want that cooperation. And the trade-off, potentially of reducing liability under a guarantee is potentially well worth it in order to garner cooperation.
From my experience, if I always tell people, it's very expensive to originate new deals, and banks put up premium on bringing deals in. It's not our goal to just kick people in the shins and kick them right out of the bank and lose money. But we need the borrowers to work with us and give us the information and be transparent. We understood the risk when we did it. If we properly underwrote, we knew that we were taking a flyer on the industry, or if the collateral had some kind of issue, or there was concentration risk in the receivables or whatever. And things happen. The cycles happen. Businesses make decisions that aren't the best in hindsight, and that's the thing with hindsight, is it's always 2020. But things change, and you react to those changes. But if you don't want to cooperate, and you don't want to give me the information I need to bring it back to my management team and explain why this makes the most business sense. Because Bill, you always say it, we make business decisions, not credit decisions. So we're making a business decision. The credit decision was made on the underwriting. We're making a decision based on the facts today, here and where they stand. Whether that's waiting 4 years to get to that, or if it's selling our paper tomorrow. It all gets back down to a net present value kind of analysis we do. And I can't do that if I'm making a bunch of different assumptions and I can't justify why, we're taking some kind of action. Or you're just being lazy, you're just hoping that I'm stupid and lazy and I just give you a year, losing money on this loan with no credit enhancements, because, I just don't want to get yelled at. And that sometimes happens too.
Yeah.
Well, I mean,
to follow up on what you're saying, I mean, at the end of the day, our job as workout professionals is to get the best risk-adjusted net present value return for our institution. That could be selling our debt today. That could be working through it for a couple of years. But in order to do that, we need cooperation from the other side. And the smaller you get in a loan, the more difficult that cooperation becomes, because people become desperate and they don't have options. People in the smaller loans have very limited access to capital. It's a business decision when you get into a larger syndicated transaction. But if you got a $5 million real estate loan, that may be this person's individual's sole asset from an investment standpoint. And, they need 5 years for the real estate market to turn around when it's not something you can offer. And they have no capital to put into it. And I think that's the biggest thing you have to realize in anything, is when you walk into the room is, let the other side put their cards on the table, because we all know the bank would just as soon be paid off.
Yeah. Well, I mean, it sounds like, I'm curious what you think about counsel. So do you think the borrower bringing counsel allows the borrower to quickly grasp and understand reality, or does that sometimes create a barrier between the bank and the borrower? Is counsel a plus or a minus in your view, Bill, or really all of you?
In my view, counsel depends on who you hire. And I've always told everyone who I've worked with and advised as they're going through this process that you don't need to be a lawyer, but you need to understand what a lawyer does. And if you just rely on a lawyer, they can lead you down a path of a complicated litigation that's just not necessary. When reality is, all you need to do is figure out what's the right path forward. So you have to understand the basic legal principles that any lawyer is going to pursue. But, most of the time when debtors bring counsel, they don't hire good counsel. They hire flamethrowers. And you just need to, put on your asbestos suit and listen to it, because fighting with the opposing counsel isn't going to do anything productive, because the borrower, regardless of how nonsensical is what's being said, is going to be happy their counsel's fighting for them. I mean, that's been my experience. I defer to Justin and Jason, but.
Well, boy, I'll tell you this, it depends. It depends.
I was going to equivocate too on my answer, so I'm glad you said you equivocated.
Yeah, it certainly does. It depends on the individual attorneys. I mean, I consider myself to be a connoisseur of restructuring attorneys. And I've had the pleasure of working with some terrific restructuring attorneys over the years. But I've also had similarly bad experiences with respect to opposing counsel. That I think the common theme, when I've had bad experiences with opposing counsel, with borrower counsel, is similar to what Bill was sharing, and that is that they're really fee driven, and they're not looking out for the interests of their client, but looking to create litigation and line their own pockets.
Yeah, and that also goes if you select the wrong counsel, or your internal counsel selects the wrong counsel because of their buddy, and they're not as upfront with the strategy as you want. And that's why I always counsel, if you're the workout banker, know your business strategy, to Bill's point, and let the attorney figure out the legal strategy and work hand in glove. But I never dissuade my workout, when I was a workout banker and ran that group. I never dissuaded the borrower from getting counsel. Sometimes I welcome it, especially and sometimes if they get the best bankruptcy counsel in that state or in that market, I'm fine with it because I know those people. Like, they're pretty reasonable. They're going to fight hard for their client, but you're going to get to a resolution. As long as you don't create a foot fault for them and make it easy, you'll get to the right place, because they're not going to, try and seek fees or put something in bankruptcy that's not there. But always go into it knowing that if you walk into a room, and I tell this, if anyone's becoming a workout banker, if you walk into a room and you didn't bring a banker because you thought it was you and the borrower, you'll need to reschedule that meeting so you could bring counsel. And there's nothing wrong with that. That's just going to be how it kind of goes. Never try and negotiate with an attorney if you're not one, is kind of my standpoint.
Well, and Jason, I think you make a very good point.
Better.
Yeah, agreed. And you're absolutely right as well that oftentimes a borrower engaging counsel can be a real positive. In my experience, really in terms of bringing borrowers to reality. Is really the primary positive that I've seen over the years.
Let's bring up the loan sale best practices. We're going to do a brief interlude here. I'm going to do a couple slides on top 10 loan sale best practices that I think would be of use if you folks ever want to sell loans. First and foremost, this does sound self-serving, and I guess it is, but always hire an advisor. In my view, there are 15 or so sellers that sell loans frequently enough. Now, some of them use an advisor anyway, but they're in the market regularly. And so in theory, they could do it themselves. Second, be a good seller. Jason ran the loan sales for Wells Fargo, and he played a significant role in giving Wells Fargo a great reputation as a seller. If you're a bad seller, and I'm not going to name names, I'll name them offline, but I would estimate there's a 500 basis point difference in price between selling a loan, Wells Fargo selling a loan, or the FDIC selling a loan, and a bank that doesn't have a good reputation as a seller. So really think through that if you're going to do this more than once, developing a reputation as a good seller will definitely help you. Conduct an
And that's being transparent and following through on what your obligations are under the loan sale agreement, and not trying to hide or obfuscate anything from the buyer. I'm not saying this as a buyer. I'm saying this that when I was a seller, the reason we did have above market execution is we relieved and transparency with the market. One, because it mitigates your potential liability to the buyer. If you sell them something and we knew of something but didn't disclose it, guess what? You're going to have to buy that deal back, or you're going to find yourself in court, which is the last thing you want to do. The whole reason you're selling us is to get a final resolution and be done with it forever. And two, buyers will discount for unknowns, and they discount significantly. You know, you don't want to provide your appraisal because it's going to show that the loan's underwater. All you're doing when you don't provide that third party report is telling them, you know, they're going to do their own collateral analysis anyway, and they know it's underwater, but you're going to give them the information. And yes, they're going to base their price off of that and off their own thing, but it is what it is. I mean, the collateral value is the value. And if you don't give that to them, and there's other information that's really helpful to them, like the age of the building and the mechanics and the, you know, stuff like that, that the banks don't usually have, provide that stuff. Because again, all right, they provided that, that's a check, that's 200 basis points of the price I'm willing to pay now, you know, so on and so forth.
Yeah.
Yeah, well,
Excellent.
you just made the most important point, which is, you know, it is what it is, and you are where you are. And if you want to get out of the deal, you know, it's not going to get better with less information. It's only going to get worse. And I think that's what people don't understand, where they think they can hide something below the surface when ultimately it costs them more money than simply disclosing everything.
Yeah, and again, third party reports. So if you only have an internal valuation done by your appraiser team, your internal team, and it has your bank's head, you know, logo on it, don't disclose that. Don't disclose your internal memos where you're discussing the credit, because that's your own internal work product, and it also creates more liability if you give that. But if it's a independent third party report, I say you're better off giving it than not. You know.
Couple other items: conduct an NPV analysis. So really have a realistic idea at the alternatives to a loan sale, how these credits will play out alternatively. Important point: keep tabs on changes to assets during the process. And that kind of goes with the last question, last item on this slide, which is be mindful of the secondary market impact. We don't recommend that you ever do something that hurts the bank if they do not sell the loan, but be mindful of the secondary market impact. For example, you have a loan coming up for renewal. The borrower wants to continue to pay. Renew the loan for 6 to 12 months. Don't renew it for 3 years at a 3% interest rate. You know, obviously that's going to have a negative impact for the loan sale.
Yeah, I have a mini war story about item number 4. We had a deal that was in one of our larger transactions, a couple hundred deals in that sale. And the officer actually executed a discounted payoff agreement with the customer and did not disclose that to me as the seller, as basically the seller. And lo and behold, when the buyer went to go collect on their note, that start servicing the note, the buyer's like, here's my discounted payoff agreement, here's the check. And lo and behold, you know, we had to make that buyer whole. But luckily they were a buyer we were familiar with. We stepped up and made them whole without question. I mean, it created a ton of questions with my operating committee. It created a lot of work on the back end, but from a reputational standpoint, like it was a must do. And that can happen. And that's why if you're going to do the process, get to an advisor and have somebody that's going to manage that group and how you're going to get the information, and remind people this is what we're doing. We're selling this. So any changes, pull it from the sale, so we just don't sell something that we shouldn't.
Yeah. Next slide. Provide full transparency to buyers. Again, there are things like credit memos, things that have to do with attorney-client privilege that you don't generally share, but certainly give people as much information as you can. It's always a good idea to look at the files and see if you can collect more recent rent rolls, operating statements, etc. That can always potentially help the price on an asset. The sale agreement must protect the bank. We've been involved in billions of transactions and have not had a single loan be repurchased, except in one small case in which the seller represented it was a first mortgage when it was a second mortgage on a small resi trade. Important to hire competent outside counsel. Very few banks are going to have internal counsel that has the background to execute a loan sale. And folks like all of us here can help you find good counsel. Another point I'd make is don't move assets to held for sale unless they sell. You don't want to be in a situation where, particularly for a smaller institution, where The asset was moved to held for sale and it didn't trade. That creates an ongoing issue. And then finally, be decisive. You don't have forever to make your mind. Don't have a bid date on July 1st and get back to people July 22nd. It's important during the process that the key stakeholders are involved and available with need be so you get the transaction closed.
And that's where you work with John or the loan sale advisor, and you get the outline of how this is going to go. What are the key dates? When are indicative bids due? When is the reserve due? When's the transaction to be done? And that's when you notify, all right, I need to get management approval on this or credit committee approval on these dates, block off those meetings. We're going to have the kickoff sale with the people that are putting in deals in the sale. So we tell them what they need to be doing, and accounting, and have everybody working on the same time frame as you manage through it. And, not to be self-serving, but, all these things, John and I put in my RMA article about how to conduct a loan sale, as well as I did an article about an MPV. If you have any questions, I'll be happy to share those with anybody.
Excellent. Well, we now go into our last war story, the last two war stories. Jason, what happened?
Yeah, so apologies if I've repeated this one. I know Bill has heard this before. If anyone is a subscriber to the RMA Journal, we actually did kind of like, this was the basis of a spilled milk article that ran a couple of years ago, but it's so good. And there's so many nuances to it with early warning signs and how things kind of unfolded. I just can't get away from it. And it's my pet cemetery story is how I call it and frame it. So back when I came over to Wells, one of the first deals I got was a 10-year deal, $4.4 million term loan secured by two commercial real estate properties to a franchise auto, motorcycle, boat dealer in Florida. The deal was on a 20-year AM. It was 4 years into the 10-year deal. And where the market was at the time, they also had a swap, which was underwater about $300,000. 2 years after that deal originated, the primary owner passed away. He had been in the business 30, 40 years. He had a 20-year relationship with the bank predecessor institutions of the bank. And the business was taken over by his daughter. Basically, the bank, without getting any documentation, released the estate and added the daughter as the new guarantor, but they didn't get any financial information on her, didn't know anything about it. And I don't know how much she was involved into the business, but I don't think she was all that involved or knew kind of the business like her dad did, because during that time or right after he died, the recession hit. They started feeling the pinch of the business cycle because they were selling fun toys for wealthy people that when you hit a great recession, that starts to dry up pretty significantly. Also, here's another early warning sign. The daughter never provided financial statements over the 2 years she was running the business. It kind of came in bits and pieces, piecemeal, quarterly statements, and that's how they were able to keep the grade where it was. But when the new banker went out to get, new banker was assigned, went out there to meet with the daughter, and basically she outlined that she had not only closed the business, but had sold the franchise rights and was in the process of liquidating the inventory. And that came as a shock to the bank. And so it immediately was sent down, moved to non-performing asset, was sent to workout when it came onto my desk. The banker did get financial statements, which showed they were also out of compliance with their debt service coverage for the last 2 years, but we didn't do anything about that. So failure to provide financials, blown debt service coverage. So we had plenty of defaults to kind of work on, and they were going to soon to be stop paying on the loan, because at that meeting, she indicated that she would just rather turn over the property to us rather than continue to maintain it and sell. So we had an appraisal from 4 years prior. This is why she thought she could just hand it over. That was $7 million. So we have about 60%, 63% loan to value. And her PFS, when we did get it from her, basically showed that she didn't have any assets besides the ownership interest in this business and the real estate value, which was underwater. We got a new appraisal, showed that the property was about 4.5 million. So we were about 100% loan to value, not including the swap, which was about to be unwound given the failure to pay. So at that time, I was thinking, let's get to some type of a cash settlement, see if she can't carry this deal. Maybe she can try and sell her, a discounted payoff or something along those lines. I didn't really have a whole lot of faith in her, but she was pretty insistent through her and her attorney that they just wanted to give us the properties and walk. Before you do that, you need to make sure you do a couple of things. One, get some environmentals. Two, like I said, we had already ordered the appraisals, but I made sure to review them and go into them pretty in depth. And when I read something in the appraisal, it caught my eye because there was a deduction in one of the properties of about $100,000 for ongoing maintenance of a pet cemetery. And I was like, well, what's that about? And lo and behold, when we did the loan some 15 years prior, when they expanded the showroom, they per county requirements had to, for flood purposes and drainage purposes, had to buy appropriating offsetting drainage easement, which the pet cemetery qualified for. So they just bought it outright. And we spread our mortgage, and that was part of our collateral. And nobody ever mentioned it in any credit file. No credit officer was ever aware that we were sitting on a pet cemetery, which in and of itself wouldn't have been the end of the world. But when I did my property inspection, it was late October. It was after work, so golden hour. We don't have fall changes in leaves, but think of Spooky Hollow, grave site, and what. It was very deathly quiet because the property was closed down. I'm looking at all these tombstones and memorials from Fluffy, and they're old, like 1963 to 1975. And I'm just taking pictures and walking through. It's like, what are we going to do with this? And then I saw something that made my heart drop. And it was basically a memorial for a person, for whoever the founder of that cemetery was. He was born in 1935 and he died in 1981. And he was buried there with the pets that he so loved and doing what he did. And when I called our attorneys and told them that, they were like, well, you could have remediated the property with the pets. Nothing to stop you, at least, legally, from just digging them up and trashing them. Reputationally, you'll have a big problem. You'll have some issues, but nothing to stop you legally. But with human remains, it's a very, very legal procedure. You got to get the coroner. You got to notify next of kin. Basically makes it an impossibility. You got to provide an ongoing easement to family. And so it basically made that property unsellable, in my opinion. So it changed my entire strategy. So I ran my NPV analysis on, having her somehow maintain this and then sell it. She didn't even have a realtor. It was going to take her 2 years, given where the market was in the bottom of the Great Recession, to sell that property. No one was really going to buy the note at that time. Note sales were still trading in the 50s and 60s, even for commercial properties. And it seemed like a stipulated foreclosure, because I, for one, don't do deeds in lieu. I always want to wash title and get a court to adjudicate. Was going to be the best result. Get to the property without a fight. You can probably get the court to sign off in about 4 to 6 months, and it'd take another 12 months or so for our ORE group to liquidate. I wanted to, because they were going to be willing to do that, and I knew that they had some money, they just weren't really being transparent on where it was. I was going to make me make whole on the value of my property. So I'm underwater when you include the swap and the fees and all the other stuff. I said, make me whole on that, pay the past due taxes, pay the future in the next year's taxes, give me the property. And oh, by the way, to lessen the burden on you, this is how I framed it and thinking strategically, to lessen the burden on you, because there's $100,000 that this ongoing maintenance with this pet cemetery. Why don't you maintain that? Probably you could do it better than we can, and you give us a irrevocable easement to just have the drainage where you can't develop on it. And lo and behold, they accepted. And we settled. We did it out. You know, we had to file everything through the court, but everything was done through the attorneys. It was friendly. Settlement agreement was signed. The Liz pendants and all the other stuff was filed, and we were able to get that property back into us relatively quickly. We got a cash settlement. We released her from her guarantee. She was not into the business, you know, that she immediately stopped maintaining that property that she gave us the easement on. And lo and behold, 8 months later, a year later, I was getting calls from Bay News 9 asking me why we weren't maintaining a pet cemetery when we took back the property. And I said, well, if you go on the property appraiser's website, you'll see that we're not the owner of that property, and we only our only rights to it is an easement for drainage purposes. But I did notify my management and media relations in case there's any future things. So that was the pet cemetery story, and one of the ones. And lessons learned: do your inspection, read your reports, think strategically how you're going to approach things. You know, we could have probably resolved this a couple years earlier had we acted on our covenant violations, failure to provide financials, failure for debt service coverage. You know, even gotten her financial statements and kept the estate in, you know, without releasing the estate with no questions asked, we could have probably mitigated some of the losses.
Well,
The old,
one thing you bring up, I think that's important for a lot of lenders to deal with is the fact that there was a interest rate swap on this particular transaction. And I don't think people realize the amount of liability the banks are in for when they downstream that product. It's one thing to use it in the corporate world, but the deal you're talking about was how much?
4 million, 4 or 5, 4, 6 or whatever it was when it was originated.
Yeah. And, you know, my bank, just like yours, and I'm sure Justin's, don't hold these on our books. We just trade them. And those are direct credit losses to us. And I think people have to understand when they downstream the product, to compete with people who are willing to offer fixed rates loan, which our larger banks are not going to, the additional liability they create.
Justin.
Yeah, and then at that time, I mean, remember, like, I mean, the loan was originated, you know, mid aughts, and then the recession happens, interest rates go to 0, but the rate was locked in at 7, so you have this huge upside down number that with a duration that goes out 6 years. That's why it was almost 10% of the loan, and it took me until, I don't know, like 2019 till I finally saw some swaps actually be in the money. I mean, my entire career was like, oh, the deal has a swap on it. Or what's the mark to market? Oh, it's a couple $100,000. Well, that loan to value just went down a couple points. So it just never seemed to work. And yeah, you're right. Like one of the things that came out of the new regulations that, you know, at the time in 2008 was, you know, making a qualified financial investor. You know, we had to have $1 million in liquidity, 10 million in assets. That some of this selling swaps that on deals that didn't really have the interest rate risk, we could have just been better off doing a fixed rate with a prepayment penalty.
Justin, you had something to say.
Oh, gosh, you know, Bill really covered it. And it's a really good point. You know, I think we've all come across these situations time and time again. And I agree with what Jason just said. Just right now, there are better ways to skin that cat at the lower end of the market. You know, I think that's the bottom line. But the old pet cemetery story, it's a good one, Jason. Although I guess at the end of the day, it's not really a pet cemetery entirely. You know,
it was not. We didn't lend to a pet cemetery, but we had it as collateral.
Jason, at the end of the day, what I was trying to say is sometimes you're better off losing a deal to a fixed rate than put the swap on it.
Yeah.
And
the banks love to swap income. They love the fee income from the swap. So the
finance
people,
John, everybody loves the fee income, and I was king of it in the corporate world for years. But when you downstream the product to people who don't understand it, all you do is create ultimately more liability than any income you can make.
Good point.
And that's really, if you're going to lose out to a smaller institution who's willing to do a fixed rate deal, you're better off losing it.
Yeah.
Because the liability you can create by doing I had people in our institution who were doing 10-year swaps on 5-year loans.
Yep. Oh, I saw many of those. Yeah.
Yeah. And it's just like, at the end of 5 years, you don't have a choice but to renew it and cut the credit spread to make the deal work because the interest rates changed. Or you tell a client that, oh, by the way, you owe me hundreds of thousands of dollars. It just doesn't work. And these products are great for educated borrowers. They're not great for every borrower. And I think that's just something as sophisticated financial institutions we have to realize.
Bill, when you have a swap, now you have swaps that are in the money, right? So, sometimes you have these loans that are performing, they might be on watch list. How successful have you been in negotiating with the borrower to terminate the swap and then use the swap proceeds to pay the loan? Now, to the borrower, terminating the swap means a higher interest rate, but it also gives them cash today. So, any color on that?
It really comes down to the situation. Once you get into a default situation, everything's a negotiation. And it's part of the long-term strategy you have to develop. It's not good, it's not bad. It's just, okay, where does this piece fall in the puzzle?
Yeah.
I had a couple deals up till maybe even last year at the bank that were in the money with the swap, but we had technical defaults that we were wanting to exit out of the relationship. And you got to be delicate with it because everything's got to go through the swap desk. So you got to make sure you're not, talking about the swap if you're not qualified to do so. So, but it's all, negotiation, in exchange for unwinding debt. Maybe we split the proceeds. We're going to bring in the maturity, but we'll fix the rate, and it just accelerates the exit. And you can kind of work. It gives, at least it's not the outright loss that we saw from any swap originated in the early 2000s till about 2019. That was always underwater. My entire career, I thought there was no reason to do a swap because it was always out of the money.
Yeah, it's as Jason said, it's just coming up with a borrower who has realistic expectations, and whether that's terminating the swap because they're in the money and you give them part of the proceeds to offset the increased interest rate in the short term while they try to find refinancing, or you just move on. There's no right answer to any of this. And I guess that's the biggest message, is that whatever we do, it's a TBD going forward, I guess is the best way to describe it. And
Bill, I think that's a great note to end on, because, boy, in many ways, for me, that's what makes workout so much fun.
That's why I love it too.
Yes, indeed.
Bob, take us away, Bob.
I just wanted to make a couple of comments on, I love the pet cemetery story. This is in the SOP, by the way, for all lenders who have SBA loans. Now, the property does not have to be listed on the National Register of Historic Places. Lenders are guided. If the property is not listed, but may have historical significance, you are required to go through steps on that. So I was talking to a lender, they're facing this, and USDA is all over this in terms of National Historic Places. So I love the contingent thoughts out there. So that was a great story. Second thing is, I just want to remind people of the dates. Payment default, you have to do a site visit within 60 days, or good luck getting the guarantee paid. And also, if there's an adverse action, you have to do a site visit within 15 days. Adverse action is you drive by the place and all of a sudden find out they're out of business. There are vendors who do that, but those are important dates. Hey, I really enjoyed the presentation, and it's going to take me a while to get Pet Cemetery out of my mind. Anna, do we have any other questions?
We had a couple others. Do we want to tackle them and go on, or should we cut it off? have one question. What?
I'm good to answer.
You know what?
Yeah,
We
let's
started
keep-
2 minutes late. Let's we'll go 2 minutes
All right,
over. Go, John.
Derek S. We won't use his last name. In the C&I space with an undersecured operating business that has potential and a reasonable executable plan, how do you assess how much time you provide the business to turn around if they don't have any meaningful credit enhancements to offer in return? No pay downs, guarantees, additional collateral, etc. Justin, what do you think?
Boy, you know, you can take it for a relatively short, chunk of time and just, take it in steps. Take it in steps. You don't have to, bite off some, lengthy forbearance period. Take it 6 months at a time. See how they do.
And I would say even shorter. I'd say 3 months. Give me your 13-week cash budget. If it's big enough, get a turnaround consultant.
Sure.
Let's figure out what's going on. But
Maybe,
at the least I need to know what you're going to do over the next, quarter, half a year, and you're going to give me statements, and we're going to take this incrementally. And if they get any extra cash flow, that's when you renegotiate.
Guardrails.
Trying to do that.
Yeah,
And at least that first forbearance, at least you can get the waiver of claims and defenses and clear the road in case there is any, litigation or bankruptcy in the future.
Justin, you had something to add?
At the end of the day, what you wind up with is that the worst case scenario for any institution is liquidation. Sale of the business is always better. And the option that management always chooses is let us operate our way out of this and everybody will get paid. So you've got to figure out the risks of all three. Liquidation is guaranteed. It sucks, but it is what it is. Sale of the company is execution risk. Can you sell the company? And the third part has the most execution risk for the lender, which is the management team turns it around and operates it. But you've got to evaluate all three on an NPV basis to figure out which one's the best for you. Liquidation is always usually the worst option.
Justin, you had something else to add?
Yeah, well, in terms of length of forbearance agreement, if you put in some, the right guardrails, covenants, or financial covenants, other events of default, you can maybe go out incrementally longer. But I think we're all in agreement on the concept of sort of a step at a time.
That's right.
Bob, take us away.
Very good. Next webinar we'll be announcing soon. It'll be on the CNI space. Gentlemen, excellent stories. I appreciate it. This concludes today's webinar.
Thank you very much.
Thank
Everyone
you
have
all.
a wonderful day.